Today we shall discuss about the basics of financial markets. In this chapter, we will discuss what is a market, what is a capital market, why do we need a capital market structure, capital market regulator, and types of capital markets. Now let us look at these two pictures. What do we see? On the one hand, there is a vegetable market, and on the other, it's a stock market. The vegetable market is unregulated. That is, the price of an orange will differ from one shopkeeper to the other. Whereas in case of stock markets, the prices will be regulated. That is, the price will be the same throughout India for a particular stock. Suppose ITC is trading at 300, it will be the same at a given point across all broking houses and banks. Now markets are of two types, physical and virtual. Physical is when there is an actual store, like say a Shoppers Stop or say a Spencer's in your locality, and a virtual one which is online, like say an Amazon or a Flipkart. In a market, the forces of demand and supply are at play. Higher the price, lower is the quantity demanded. As the price goes up, so does the opportunity cost of buying that good. Opportunity cost is loss of other alternatives when one alternative is chosen. Say if the price of a movie ticket goes up, the person might skip it since he has a predefined budget for the weekend. In case of supply, higher the price, higher is the quantity supplied. Producers supply more at a higher price because selling a higher quantity at a higher price increases the revenue. In a market, the buyers and the sellers interact either through a middleman or directly. I could be buying a good, like say a pair of jeans, or I could be buying a service, say booking a ticket through a travel agent, or I could buy it directly from the airline company. In a nutshell, markets are platforms where buyers and sellers interact and transact. Now let us discuss how an economy works. In an economy, the fundamental decision making lies with the firms and households. The firm produces goods and services and sells it to the households. Households supply land, labor, capital and entrepreneurship to these firms, which they use to purchase land, factory, office building and equipment. Households buy the goods. The price that they pay is the revenue which the firm can use. The households save for the future by putting money in a bank, or they buy stocks or shares or corporate bonds. Hence they supply the firms with funds to finance such expenditure. The government needs money in the form of taxes, both direct and indirect, to build bridges, roads, ports, airports, etc., which they collect from these firms and households. In an economy, the entrepreneurs are the buyers since they take loans from the banks, etc., who happen to be the intermediaries or the middlemen, and the sellers are the retail investors, that is the common people at large, the FIIs or the foreign institutional investors, the mutual fund companies, insurance companies, etc. Hence we need a capital market so that this entire process becomes easy and transparent. And for this, we also need to have regulators in place who keep an overall check on the entire thing. For that, we have SEBI, RBI, IRDA, etc. SEBI or Securities and Exchange Board of India is made to protect the interests of the investors in the stock markets. The RBI or the Reserve Bank of India regulates the banking, and the IRDA, that is Insurance Regulatory and Development Authority, regulates the insurance in the country. Now capital markets are of two types, equity markets and debt markets. In case of equity, the shareholders are the owners of the business with all the risks and rewards associated with the business. In case of debt, however, the company has an obligation to pay the principal amount along with the interest for a specified time. Hence we come to the end of chapter 1. In the next chapter, we shall cover primary market instruments. Until then, goodbye.